Welcome back to the Beat the Odds, a Business and Wealth podcast, Trevor. This is interesting episode. So we had some thoughts on what was going to happen, and we've seen some pretty wild things play out this week. And I think it's important for people to break down the numbers of that and understand what we're dealing with here. So
yeah, there's a lot of craziness. A lot of people have lost their minds over Trump and tariffs, and the markets have been up and down all over the place. There's a lot of claims, Trump's manipulating the markets and all of this stuff. And
yeah,
let's jump into this a little bit and try and get a better understanding of what's actually happening, and try and look through our murky crystal ball to see what how to plan for this and how to go forward.
Yeah, how do we play it? How do we play it, right? Because I don't know, Trump didn't call me when he, a few hours before he was going to get the go on reversing the tariffs. Did you get the call, Trevor?
No, I did not receive that call. Like the meme there, tax on, tax off, tax on, tax off. It's hilarious. Like, what's going on here? He's completely playing all sides. Nobody knows what's going on. We've got, mass hysteria. And I'm hoping there's a master plan involved, but if not, what's the outcome?
Let's break it down. Okay. So, Trump takes over, inaugurated in January. S&P 500, 6,100 points, okay? 6,200 points, and then tariffs. He's already sounding the war drum about tariffs before Inauguration Day. And so...
Oh, yeah.
Okay, so what's the play? The play is let's try to drive down the stock market to reduce the interest rate. I think that is the main play. Can you raise some money on tariffs? So it's like, yeah, you can raise some money on tariffs, but we have to understand the significance of tariffs. So I have to, how much do tariffs mean? This is actually the U.S. Census Bureau. This is basically the balance of trade between countries. Okay. And this is from the U.S. government directly. And you can see that there's a trade deficit of $1.2 trillion. Okay. $1.2 trillion is the trade deficit. Okay. So, and you look, it's very difficult to they even group North America right up top there. So they have $235 billion from Canada and Mexico combined. Okay. I think we've said on previous episodes before, to put tariffs on Canada and Mexico from the U.S., it's tricky. Because
yeah, for sure, because they'll be right close. We're attached to each other. Yeah,
these are integrated supply chains, right? So you're going to get tariffs at each step. You get an auto part manufactured in Ontario, and then it goes to Detroit, and it's stuck in a transmission, and then the transmission goes back to Ontario, gets shipped to Mexico, and then it gets assembled in a car there, and then it was like, so you're just going to get tariffs on top of tariffs on top of tariffs, right? And so it was not. I mean, he had everyone looking left on Canada, Mexico, Canada, Mexico, Canada, Mexico, and then he releases the list of 180 countries, and it's like every country except Canada and Mexico on there. And so is that the art of the deal? Probably. That probably is the art of the deal. Okay. So I do think there's some things that are planned, they're the art of the deal, and some things that they're probably surprised on too. So I think that was probably the plan all along in terms of the tariffs, because let's say if it's just, what is the problem that they're working with? We got to go back to the problem. So always this is the problem, because people they zoom in and look at the problem. You got to zoom out and look at the problem. The problem is that they're $37 trillion in debt, and they have a $2 trillion deficit every year. A $2 trillion deficit every year. Okay. So what happens if, and you have to get this deficit down to 3% of your GDP. So GDP is at 29 trillion. Let's call it 1 trillion for sake. Okay.
Sure.
So this is $1 trillion over. Okay. And that's just not me thinking about that. It's like, I think Ray Dalio came out and gave that number. I've been telling people like optimistically a mature economy can grow by 3% a year. Ray Dalio came out, I think this week, and actually stated that exact same number. Okay. So this, instead of being 2, it needs to be 1. Okay, so you have to reduce expenditures or you have to increase revenue. Okay, so you have $5 trillion in revenue and you're spending $7 trillion. Okay, so you have a $2 trillion problem. You can actually have, you can have your debt grow in proportion to your GDP. It'll probably be okay. It's not ideal, but it's okay. You're treading water essentially. Okay, it's like your mortgage payments going up in proportion to your income. Okay.
Sure.
It's not ideal, but it's okay. Okay. So a $2 trillion issue. So let's go back to this list here. Canada and Mexico are only $235 billion. So you start talking about a 10% tariff. Okay. That's only $23 billion. You have $1 trillion problem, and you slap a 10% tariff on Canada and Mexico. That's only that's only $20 billion. It's only $23 billion. Okay, so I mean, even a 25% tariff, it doesn't work on that. And so what happens? Sounds the war drum on tariffs, and hammers on Canada and Mexico. And then when the list of tariffs comes out, it's basically everybody but Canada and Mexico, right? With kind of these 10% baseline tariffs. Now, tariffs are like taxes, okay? Tariffs are like taxes, where people think that you could raise tax rates to 99% on the rich and somehow the government would just rake in all the money. But there's something called a laffer curve, okay? So basically with, a laffer curve on a crude basis, like if you charge 0% on tax, you will have $0 in tax revenue. But if you charge 100% on tax, you'll also have $0 in tax revenue because no one will put any capital to work. The capital will flee your system, and people will do any sort of crazy planning or even downright tax avoidance not to pay, because the worst they're going to do is go to zero anyways. So, and so somewhere in between 0% and 100% will be the maximum amount that you can raise. And on tax, like most people, pretty much agree it's somewhere between 35 and 45%. And so like if you're looking at like actually maximizing the revenue, it starts to after call it 40%, the revenue that the government collects actually starts to go down when you look at the data objectively. So people say just tax the rich 60%. It's like, all the historical data suggests that you might feel good about that higher rate, but they're actually going to get less money out of them because capital is going to flee, less money is going to go to work. Like, why am I going to take a risk with capital if the government's going to take 90% of it? I won't. Like the risk reward just isn't there, right?
Exactly. Especially when we have an open continents that you can do business. You can do business in China. You can do business in South America. You can do business other places. You can put your capital to work somewhere else rather than Canada.
So now, hammers down, and then it becomes a 10% tariff. Okay, so it becomes a 10% tariff. But look at what the tariffs would have been to begin with. 10%, I think 10%, like, you got a shot at getting at 10%. And first of all, like, it might sound really good that you're going to put 100% tariff on China and 10% on everyone else. But you know what China's going to do is they're just going to ship that stuff to Vietnam or Turkey and slap a different sticker on it, and then it's going to come to the U.S. Right?
Yeah, well, then you're talking about intellectual property theft, and they don't care.
Yeah, like it's just good. It's like Russian oil, right?
Yeah,
it's oil. It's product. So like you're not really going to be able to police that very well. So when you have really high tariffs in one jurisdiction and really low tariffs in another jurisdiction, it's going to become just really difficult to police that. So it's almost pointless. It just increases their shipping cost is all it does at a certain point, right? Where, maybe if you have a 15% in China and a 10% everywhere else, it's not worth shipping it around. But once those start to get too different, it's going to be, it's not going to work. So.
Well, I think what people say about tariffs is like nobody wins a tariff war. Like nobody is going to win in a trade war. especially in this interconnected world, like everyone's been pushing for globalism and connected markets and all of these things for decades. Now all of a sudden you want to decouple all of that and reverse it in a day or in the matter of like a 4-year term. It's going to cause turmoil and disruption, and in the long run, I just don't think it's going to work.
Yeah, right? I think on an optimistic basis on tariffs, you could have got 10% on that, and so that $1.2 trillion basically would mean an additional $120 billion in revenue. Okay, so you remember you have a $2 trillion problem. Arguably, you might have a $1 trillion problem, because as long as you can cut the deficit down to that, and like this is like the optimistic outcome. I'm not telling people this is, you could get $120 billion of tariff revenue, because tariffs also put downward pressure on the GDP and the efficiency, and there's a whole bunch of downsides. But I'm just saying, like, I think the most optimistic outcome of tariffs is an extra $120 billion in revenue, which sounds like a lot, but when you have a $1 trillion problem, it doesn't solve the problem. It doesn't solve the problem. It helps, okay? So at most, they knew going into this that probably the best outcome, $2 trillion deficit, you need to get it down to $1 trillion. Yeah. The tariffs were $120 billion. 12% of your problem. 12% of your problem, right? And Musk was sounding the war drum. On DOGE. DOGE is going to save us. And you even see this DOGE clock that they, but basically the DOGE clock is not an annual clock. The DOGE clock is how much DOGE is going to save us forever over the next 100 years. Okay. So DOGE is expected to save us save the Americans $305 billion. Okay. So $305 billion. And I've been telling people, it's like, that's a forever clock, not an annual clock. And we've turned out that is correct here. I had a clip of Elon actually saying it. Let me just find this clip here. Let's go to X and Elon. DOGE 2026. See if I can find that clip. DOGE savings.
When it comes to these tariffs and, people really losing their minds in Canada specifically, you have Doug Ford going on, news channels, talking about, how it's going to hurt the Americans and all this. It just feels like there's so many people that are just uneducated about money, about tariffs, about all of these things and how they affect different things, that they're coming at it from the wrong angle. Like, I think Canada itself needs to just work on producing more stuff and unleashing the stuff we've got in the ground and selling that. An
emotional position followed by an emotional reaction, as opposed to how much are tariffs worth? Like, how much can you actually get on a tariff? What's the logistics of it, like, breaking down? Okay, so here's that clip of Elon, and this is what I've been confirming all along, and they're going to confirm it now. So,
thanks to your fantastic leadership, this amazing cabinet, and the very talented DOGE team, I'm excited to announce that we anticipate savings in FY26 from reduction of waste and fraud by $150 billion.
I'm going to play it back. I'm going to play it one more time. I just want to make sure. Just listen to the date.
We anticipate savings in FY26 from reduction of waste and fraud by $150 billion.
Okay. So by 26 of 150 billion. I mean, I told everybody, Elon first said, DOGE is going to be $1 trillion. I remember once upon a time when Elon said, I'm going to get my Cybertruck in the next year, and then that thing was like 5 years later, and I didn't want it by that time. So I mean, that's kind of the nature of tech businesses: overpromise, under-deliver on timelines and stuff, right? So $150 billion. So again, and that's by 2026. So is that like the first 18 months, the first 2 years? Is that in 2026? Like, optimistically, let's just say that's $150 billion a year.
Sure.
$150 billion a year. Okay. So that's what I tell everybody. It was never about the tariffs and DOGE. The biggest problem here, I just go back to this debt clock. You have $1 trillion in interest expense. You have $1 trillion in interest expense, and a third of it is expected to renew at 5%. So current rates expected to renew at 5%.
So a third of $1 trillion renewing at 5% interest rate. So then what does that do? Like, I think that's terrible. Could you imagine, like, you have debt and you're going to be renewing at like a much higher rate than you originally bought that debt? Like, what are the implications?
That's 1.8 trillion. That will go from 1.8 trillion. So that's an $800 billion increase in your expenditures. And DOGE and the tariffs combined are $270 billion. Best case scenario, best case scenario of everything they're saying, like, because that's their new 10%. That is the best, most optimistic scenario. So I'll say it again. It's like this whole thing was interest rates. Mm-hmm. This whole thing was interest rates. Like they're not stupid people. So the whole thing was interest rates. And so here you go. Here's the play. You start rattling the war drums on tariffs, and maybe it gets you some extra money. But at the end of the day, it's like you're trying to drive capital out of the stock market and into the bond market. Okay, you're trying to drive it because as you have more buyers for bonds, they're willing to accept the lower and lower interest rate. Mm-hmm. Okay, so you're trying to drive the capital out of here into the bond market, and they're doing a pretty good job. First off, you have an S&P 500 starting at 6,100, and you drive it all the way down to 4,900. Okay, this is the yield. Okay, and this is kind of what happened here. Let's go to the 3 months, and they take over. Inauguration, we're talking about 4 3/4, that 4.75, 4.5. Okay, they get it all the way down to 4%. Okay, they get it all the way down to 4%, and just a half a point alone, one half a point is more. If you have your debt renewing at 4% instead of 4.5%, that's $180 billion. That half a point is more than DOGE, and it's more than the tariffs. Just a half a point in interest is more than either of those line items, right? Like that is the main thing that they're doing. They drive it out, but then it stopped working, and then it stopped working, right? And it stopped working.
What are the things that stopped this from working? Like what were the trigger points? Like what actually happened in real time? Like that's the funny thing about this. Everything's happening in real time. Everything's happening rapid fire. Mm-hmm. Like what happened so that it went from going in the toilet back up to like where we are today?
Yeah, no one's gonna know in the immediacy exactly where it went, but here are the general causes, right? And you're dealing with big organizations, foreign countries, and so some of them, their reporting is opaque, and almost all of them reporting is delayed, right? But at some point, what happens is, theoretically, you can drive money out of the stock market into the bond market. But then at some point, what's likely to happen, what's likely to happen is you end up driving money out, you spook the bond market, and then all of a sudden the bonds, the money in the bond market starts going into gold. Mm-hmm. It could go into real estate. It could go into foreign stocks. Okay, so it could flee the U.S. altogether. Right. Okay? Yeah. And as you drive capital out of the bond market, you have less buyers of the bonds, and they want a higher and higher interest rate. Okay, and then you also have a couple other things, as you have portfolios that are like 60-40 splits. People just blindly put their money at financial institutions that want to have 60-40 splits. So when you drive the stock market down, they will take money out of the bond market to prop up that, to keep that allocation the right way. Okay, so they have a desired allocation, and that's going to be one reason. Then you have the degenerates in the market who it's just based on margin. So they need to sell their treasuries and their bonds because they're getting margin called on the drops. Okay. Then you have bonds held by foreign holders, and as you inflict pain on them, they need to sell their bonds to buy their currency, or they just sell their bonds. If you're China, you just sell your bonds out of spite just because you know what's happening, okay? And so you get these factors that eventually it starts driving capital out of the bond market too. That's what happened. They got it down to 4, and then it went back up to 4.5. Like basically, and that spike back up to 4.5, that's what precipitated the we're going to put the pause on here. We're going to put the pause on. Now, some people say that's a failure of this whole thing's 4D chess. It's like, they didn't know where this is going to break. Like, nobody knew. It's like, but you got to try something.
Yeah,
you got to try something because you have this problem, right? And so eventually, you know, when I look at this now, Trevor, it's like I feel so much more uneasy this week than I did last week.
Yeah.
Because last week it's like I know what they're doing. They're going to try. You have no idea where it's going to break. You know at some point it's going to break, but you had to give it a try. You had to give it a try. It seemed like an effort. You have a chance to do it. You have to somehow get down to that reasonable level, because what you don't want is like a massive spiral. Okay, so you have. And I've always thought, like, the third prong, the only other plan that they've talked about is you had DOGE, you had tariffs, and you had Bitcoin. Like, these are essentially the only 3 things that they talked about on the campaign trail. Like, these were the 3, things that they were going to try. They haven't tried the Bitcoin yet, okay?
Well, there's some announcements yesterday, I believe, or was early this morning, about them buying, a bunch of Bitcoin. Yeah, right. I was looking at it briefly today.
I haven't seen any confirmation on that yet. I've just heard talk about buying it, right? I cornered Eric Trump, and he just talked about it. Didn't commit to buying it in 2025. It's like, why do you buy the Bitcoin? I hear people like, oh, they're going to eliminate tax on crypto. It's like, no, they need to buy the Bitcoin to keep the tax in there. They need to drive Bitcoin from it being a $2 trillion asset to make it a $20 trillion asset that, Americans are selling 5% of it off every year, and it's owned by the most richest Americans. And so they're going to sell 5% of it off every year. That's $1 trillion gain, and they're going to pay tax at 50% of that, right? That's $500 billion in extra revenue. That's a real thing. And so that's a way to inject money into the system that's not really going to drive up the prices of everyday things. You need to monetize something, because the rich people aren't going to buy that many more flat screen TVs and groceries and gasoline. It's not going to drive up of ordinary things. There's very few people on planet Earth who have any substantial amount of Bitcoin anyways.
Well, if they're going to tax Bitcoin, they're taxing the gain on Bitcoin. How is that so far removed from the fiat fake money that we've got right now? If they can tax this because they issue it, they're not issuing Bitcoin. Like, how are they going to tax that? And what's the benefit of owning Bitcoin?
The benefit of owning Bitcoin is if it goes from if it goes from $90,000 or $80,000 to $800,000, you 10x your money. So you're happy to pay the 50% tax. And how they're going to tax it, very few people will own self-custody Bitcoin. Most people are going to own Bitcoin in taxable retirement accounts. Like, they're going to own it in Canada in their RSP, and in the US in their retirement accounts too. So they're going to be able to get their tax revenue from Bitcoin. So what's the benefit? It's just the benefit of owning any asset that goes up. And it probably, I still hope they do it, because I think it provides some stability to the financial order. Like, I think if the U.S. government does it, they monetize the new world's reserve asset, and they own the majority of the, they're the biggest holder of the world's reserve asset. You basically get some political stability. I see them being, if they did that, they'd be the world's reserve currency, I think, for the next 100 years. I still don't know if they're going to do it, because they're dragging their feet on it, right?
Well, let's be a little bit realistic here. We are in April. It was inaugurated in January. So
I said give it a year. But if it's not done by, that's what I said at the outset. If it's not done in a year, I don't think it's happening. I said give it a year. And then, what's the other thing that could happen is, I mean, the only other thing that I foresee is Jerome Powell's up in May of next year, I believe. So he is up in. He'll still be on the board of directors, but he is up. His appointment as the chair will be up in May, and so the only other play here is basically what you have to do is you just have to get someone in there. You have to appoint someone, who's going to make, like Ben Bernanke, who printed all the money in the financial crisis. It's going to make him look like Paul Volcker, who was the biggest hawk in the 80s, who didn't, who jacked interest rates up. So because what they'd have to do is just shamelessly print the money and go into the market and buy bonds, and drive that rate down, and just shamelessly print the money and drive that rate down. That's kind of the last resort as I see it, because I don't think you can leave that $2 trillion amount just keep going and going and going. It's like when this thing breaks, no one knows where it really breaks. I mean, I suppose it certainly breaks when your tax revenue is smaller than your interest.
that would definitely be broken.
For sure, it's broken then. I mean, I would think all likelihood it really breaks down before that. But I think, I've heard Thomas Sowell say that. I've heard Ray Dalio say that. It's certainly that's definitely the end. And, we've assembled some models here and said that, we use AI and assemble some models. We were doing that. And, we came up with models from, it could happen as soon as 2030. And it's at this,
for sure at 2035, I think.
Likely at this trajectory at 2035 and, probable, and almost certainly by 2045, right? Wow. So they have to do something, and essentially how they would change that trajectory. It's we've just said it here. It's if they execute tariffs to perfection, that's $120 billion. It's only 12% of your problem. Okay. If you execute, DOGE effectively, that's only 15% of your problem, right? Because you just look at what they spend money on. They spend money on Medicare, Social Security, defense, and interest. Okay. So even if you got all the other expenses in the budget to zero, it's these are almost all of them. These are almost all of the expenses. And we already know that I believe they've pledged to increase their military spending from kind of $900 billion to $1 trillion or $1.1 trillion, I believe. So you have to have big line items. If you can cut this interest expense in half, that's $500 billion. And so if you can get $100 billion, if you can get $120 billion in tariffs, and you can get $150 billion in DOGE savings, and I really hope they can get a couple $100 billion in tax revenue in Bitcoin. But other than that, what's left to fill the gap? Money printing. It's just money printing to drive that interest rate expense down and down and down and down, right? To just shamelessly buy the bonds like they do in Japan. So, and then because there wouldn't be enough buyers at the 4.5%, but there are some buyers that exist just because that's just their policy. Pension funds,
sure.
They're just going to buy bonds. Insurers, they're going to buy bonds for regulatory reasons, and it's inherently tied to their product, right? So there's a certain kind of psychopathic buyer that just buys them regardless of the price because that's their business model. Commercial banks, they have to by regulation. So, but then other than that, you just need another big buyer, and there's no one else who can do it. It's the Federal Reserve. So it's, chewing gum and Band-Aids putting it together until Jerome Powell does that, because I think they didn't get as far down the path as they'd hoped, right? It was worth a shot. Could you have got the interest rates down to 2 or 3% just on tariff talks alone? They tried. The bond market rejected them, and that's it. Because ultimately, the Federal Reserve only sets the short-term rate. The market sets the long-term rate, and you spook enough people, and they exit the bond market for those reasons, right? And that's what we saw here. So it's kind of somber day. Like, it's kind of a somber day because, in the interest of stability, I was hoping they would get further down the path before it broke, and it was worth a shot, but they didn't get there. So,
Well, let's bring it home to Canada, and what are some positives that could potentially come out of this, or how can our audience, business owners who have Canadian businesses and Canadian interest, how can our podcast viewers, what can we take from this, and how do we prepare? How do we invest? Like, what's the short term and then potentially long term solutions to the mayhem that's going on?
Asset prices are going up. They're boxed in. They have to print a whole pile of money. So you're going to move a large percentage of the wealth from the people who do the work to the people who own the assets, to the people who own the real estate, to the people who own the high quality stocks, to the people who own the gold, to the people who own the Bitcoin. Like, that is going to happen. Wages are going to get devalued in the process because that is how money printing works. It moves the money from the people who do the work to the people who own the stuff. But ultimately, it's the lesser of two evils, and almost this distraction with DOGE and tariffs from the real issue that they're broke, and the only solution is money printing. It's a blessing and a curse, right? So it's like you have people yelling at the top of their lungs back and forth to each other on relatively small issues. So. Yeah. You have a $1 trillion problem, and they're yelling back and forth to each other about $100 billion solution, basically, right?
It seems silly when you think of the actual magnitude.
It's an order of magnitude too small to solve the problem, right?
Crazy.
And so, but that's cursed because they're not talking about the real thing and they don't understand the real thing. But it's a blessing in that, man, if people really understood the real thing, like,
there would be carnage.
There might be chaos in the street if they knew that the only thing for them to do is, it doesn't matter how you vote. Like, they're just going to steal from your future earning power and pump up the assets of the rich people.
Yeah. So
like,
when your future is based on the fake stuff, there's no other options. Right?
So that is that's the blessing of it. And if you actually truly understand it, you understand that the path is clear. The timing's not clear. People need to stop trying to be as if we're not Charles Schwab. We're not getting the call from Trump before he's going to make the announcement that you can trade that. It's like, and you don't have to trade it. And in any sort of taxable scenario, you couldn't trade it anyways, because you'd have to trade it and overcome your tax rate, right? It's buy and hold quality assets that are likely to keep pace or outperform real inflation, real money printing over time, right? That's what we want to do, and we just have to acquire the right assets that are going to do that, because this thing is coming, and it doesn't even have to be the perfect asset, right? It just has to be a grouping of assets, because you have to understand there is no perfect asset, because all of those assets that I mentioned, whether it's real estate or high quality stocks or Bitcoin or gold, it's like we're not operating in a free market. We're operating in a market where the government can manipulate any one of those, and they're likely to manipulate some of them more than others, some to the good and some to the bad, right? And so not being spread across those assets is a massive risk. Not having any is the biggest risk, and not being spread across those is the next risk, right? But you're very like this is going to happen, right? They didn't get there with the stock market alone. They tried. And so now at this point, it's, they're going to try to execute these tariffs. They've already told you now what DOGE is worth. So stop saying that DOGE is going to fix the problem. And $150 billion of cuts also has downward pressure on the GDP and the tax revenue too. So because some of those, fake payments are actually going to people who actually pay fake taxes too. So, and they buy real stuff. So that, we know what's coming here. It's actually not going to get solved with tariffs. It's not going to get solved with DOGE. It's like there's only two things left then. It's Bitcoin, which they may or not even pull on that lever. And then whatever's left over, they're going to fill in with money printing. and you're just counting down now till they can get their new chair of the Federal Reserve in there. And because Powell's not going to do it. I believe him. Like, I think he's like, unless the bond market, I'm sure he has a limit on the bond market. Or, is he going to start printing at 8%? Sure, he will. He'll start printing at some point, but I don't know if he's going to get there by the end of his term in 2026. But at the same time, because he doesn't really care about the debt, he just cares about inflation, employment, and the stability of the bond market, right? So if the bond market's 5%, it's still stable. It's still functioning. It's tacking on to the debt. So at the end of year 4 of Trump's term, that's going to be a big problem, right? Mm-hmm. But at the end of Powell's term in this time next year, not a big problem, right?
Right.
So he'll only step in if it starts dysfunctioning, right? And I don't think that's likely in his term. So we know what's coming, and I would say Trump's likely going to put someone in there. Like I said, it's going to shock the world, right? I don't know how he's going to sell it, but Trump's the salesman, so he's going to brand it some way, and they're going to call it something other than money printing. But like, they're just going to have to buy the bonds, right? Yeah. They're going to have to buy the bonds to drive those rates down. You just go back to the colossal mistake that they had when they had everything at, basically 0%, and they could have locked everything in at 1% over 30 years, 50 years. They could have issued 100-year bonds, but they tried to save an extra 0.5% by putting stuff on short durations, and now
and this was under Biden's administration,
right?
Like
they really just dropped the ball there. Like, it's a really small amount of savings, and that interest expense could be that interest expense could be $250 billion right now if they would have played it well, but instead it's $1 trillion, and all renewing at higher. It's scheduled to renew up to $1.8 trillion. Just so totally dropped the ball on that, and but they were trying to save $100 billion. While I'm playing with those durations.
Thinking, that's my biggest problem with politicians, politics, and all of this. They look as far as the end of their nose and no further. Yeah. Which is why China is kind of in a strong position, because they're thinking 100 years, 500 years, 1,000 years down the road. Like, what is China going to be? And like, our cycle is so short that they look to their end of their 4-year term, and can I get elected again? And it's ridiculous.
Yeah. Right? And so, like, it's the right investments. It's also rates. You have to understand that the system is set up for to basically move the money to people who know how to borrow effectively to invest, right? Yeah. And so I told everybody when it was, going to be higher for longer, it's like, it's not going to where it was in the 80s. It can't. The system can't handle it. There's 3 times as much debt in the system as there were in the 80s. 7% now is it's the same amount of stress as 21% before. It's the same. It's the same thing, right? And so, where rates going is like, they're going lower. Like, rates are going lower, right? Does it happen, between now and this time next year? It's that's going to be, tough slugging, right? Inflation's going down. They had a pretty good inflation rate, but like, they're going lower because the biggest, the person who owes the most money are the governments around the world, and they can't afford the debt load. And so asset prices are going much higher because they're going to have to print money to buy the bonds. That capital is going to get injected into the economy, and the people closest to the money printer, they're going to buy more desirable assets, and that's it. We know what's happening now, and it's going to happen to a bigger degree than was evident last week.
Wow.
Yeah.
Okay. Well, folks, I think that pretty much sums up this podcast. There's like 3 or 4 tickets left for the boot camp that's coming up May 10th at West Edmonton Mall. And if you want to get a ticket, go to spurrell.ca and click on there, grab your tickets, and we will see you at the boot camp. Anything else, Josh?
That's it. We'll see you next week, guys.
All right.